South Korea's bond market just flashed a warning that every emerging market and rates investor needs to see right now. On July 24th, the 3-year Korean government bond yield rose 4.2 basis points to 3.959%, the highest level since November 2023. The 10-year yield jumped 5.5 basis points to 4.447%, and the 2-year added 5.5 basis points to 3.801%, a broad sell-off across the entire curve. The trigger, a sharp spike in global crude oil prices, which markets are reading as a reignition of inflation. This lands just 9 days after the Bank of Korea raised its benchmark rate from 2.50% to 2.75%, a unanimous 7-0 vote on July 16th. Now oil is threatening to make that hike look insufficient. Here is the structural contradiction. Semiconductor prices drove South Korea's national income up 13.2% in the first half of this year. But manufacturing payrolls fell roughly 9,000 workers year over year in the same period, income up, jobs down. That K-shaped divergence makes the Bank of Korea's next move extraordinarily difficult. Hike again to contain oil-driven inflation, and you amplify stress on one of the world's most leveraged household sectors. Real estate and domestic consumption take the hit. Hold rates and inflation expectations become unanchored. For U.S. investors, watch the KRW-USD rate and Korean sovereign credit spreads. Rising stress there tends to ripple across other oil-importing emerging markets. With oil pushing Korean yields to multi-year highs just weeks after a unanimous rate hike, the Bank of Korea is caught between an inflation spiral and a household debt implosion, and there is no clean exit.